I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling an enterprise view of exposure. As the global subscription market digitises, the roles of market leaders and followers are becoming much more clearly demarcated. There are businesses designed to be leaders with large investments in class-specific expertise and specialist distribution relationships who are looking to align followers and consortium partners behind them. There's also a parallel class of follow-only underwriters looking to support and amplify those same leaders. It's a modern twist on the oldest symbiotic relationship in the subscription market. Ki is an example of a wholly digital business that is looking to become the ultimate following market. And this expansive conversation with its CEO, Mark Allan, sketches out what much of the future of London underwriting is going to look like. Ki has been a first mover in the world of algorithmic underwriting and has built a billion-dollar business that has matured, become independent, and is now offering to share its expertise as a tech partner for underwriters and brokers alike. Mark knows more than any of his peers about what is achievable and what's likely to change in the London market of the future. On the basis of this conversation, the future of the market should be very bright, as it becomes much faster, more agile and responsive to brokers and clients, while at the same time becoming much more efficient and productive and a genuine alternative home for the sort of business that has traditionally only been accessible to local market underwriters around the world. It's fascinating and invigorating stuff. Mark answers all the big questions and many more besides. You'll learn a lot and the time will rush past. Enjoy the podcast. Mark, welcome to the Voice of Insurance.
Thank you. Good to see you again.
For anyone who doesn't know you, why don't you just briefly introduce yourself, give us a bit of a run through of your career to date and how you got to be where you are today.
Sure. So Mark Allan, I've been with Brit about 15 years, running into the launch of Ki in 2020. Just before we started Ki, I was the group CFO for Brit. Before that, I was a management consultant at McKinsey and trained as an actuary. So a few years knocking around the space before that.
Well, McKinsey's a good pedigree. Obviously now the new chairman of Lloyd's is also a fellow alumnus, I think.
Absolutely, yeah. There's a few of us around.
Yeah, and Mr. Mazzayardo. And anyway, I would go down a terrible rabbit hole if I was trying to remember everybody who ever worked at McKinsey who now works in insurance. That's probably a tricky one. You were saying been at Brit for a long time. Now, officially, are you still at Brit running Ki? Is Ki still related to Brit, or now that you're running your own syndicate?
So today we've separated from Brit. So we're still both Fairfax companies, and Fairfax runs this great decentralized model where we have all the companies working alongside each other in parallel, which is really good actually. And I think it's one of the things that brought us to where we are today. And what Fairfax allowed us to do, and Prem Watson, the founder, allowed us to do, was to start up a new business within Brit. And that takes us back to the start in 2020, when we were inspired by the Future at Lloyd's, the blueprint, to come up with the digital and data-led model that we've built today. And I think to your question, Ki was fairly independent from the start. So if you remember, we've always had our own syndicate. We always obviously had our own brand. We had our own team. And we raised 500 million of capital back in 2020 to back the venture and to back the 5-year plan. So we started off pretty independent as a unit, if you like, as a business within Brit. And then at the end of last year, we completed the separation. So we're now effectively a sister company to Brit within the Fairfax group.
So give us the latest, what's happening at Ki at the moment? What are your plans right now?
So the big thing for us recently, last year we launched the partner capacity. So if you go back to the start, Ki's always been digital and data-led and an algorithmic follow business. So we're focused on that core and maintaining that focus on underwriting through the platform, through the digital model, using the algorithms. Last year, we saw a great opportunity to introduce some partners. So they work with us using our algorithms to offer this same follow capacity through the technology stack that we use. And that creates a really great dynamic for the broker where they can come and use our platform. And for the same amount of work as before, it's literally the same experience for the broker as before. They're able to get more capacity, more follow lines, and that makes their process more efficient.
And how does that work? This is more of a technical question. Do they effectively get the same sort of dashboard that you've got? Or are you giving them the full capability to use your algorithm and say, yes, say, for example, is it just a bolt-on total quota share, whole account quota share type thing, which is just one piece of paper renewed once a year? Or is it the sort of thing where they're using your platform, they've got the same sort of Blofeld's dashboard of different knobs and whistles and things to push and pull and levers, And conceivably, for example, if they'd set their settings differently and their appetites differently from Ki, for example, the core Ki, could you get Ki's offered you a 10% line, so this is a broker, but the other two have declined, for example?
So I suppose there's two sides to that question. One is the broker experience and the other is how the partners interact with the technology and with Ki. What we wanted to do on day one was keep it simple. So with technology change, something new, it's really about execution. Execution risk being low is really, really important.
So it is much more effectively like a whole account.
So for last year, it was really the same appetite as Ki, if you like, multiplied by a percentage. What we're doing gradually is introducing differences. So actually for 2025, there are some differences in appetite. And then you can imagine 2026, we're going to start introducing more differences between us and the partners. If I just go to the broker side, because I think the broker experience is something we really focus hard on. And that's, it's an important part of our model. There's two important things. One, it's as easy to use for the broker and as efficient for the broker. And I'm sure we'll come back to that theme. The second is that the broker has choice. And we want to have this concept that the broker is empowered when they're using Ki. So we'll offer them our lines, then they can discuss with their client whether they want to use the Ki line or the Beazley line or the QB line, all of them, none of them, it's their choice. So it's not a quota share in the traditional sense. They're very much independent lines that the broker and client can select from.
So it's clear that that's the sort of ambition, that's where it's going to be. If we're talking in 20 years' time, it would be just there's a Ki technology at the core of this, and they could be pressing many different buttons and dialing up appetites in a completely different way from you, i.e. completely, being their own underwriter, but with their own algorithmic underwriter, changing those appetites so you could have different outcomes.
Absolutely. And we see ourselves as effectively a technology partner playing in the middle here. So we've got some great technology that we use for our own account, and the partners are coming in to use that technology to offer capacity to the brokers. We're also, and you might have seen, we've also done some interesting things with brokers where they can use our technology as well. So we've talked about the Howden integration recently through Howden did a press release on it. So we're also looking at, are there ways brokers can benefit from the Ki technology? And in that case, what we've done is we've helped Howden to manage their facility using our platform and using our broker workflow. So their brokers have now got the ability to generate a tracker line and an open market line in one easy to use online experience.
Yes. So they've decided rather than build that tech themselves to say, well, hang on a minute, you guys have already done it and we can see how good it is. Yes, why bother?
Exactly. And for us, we've got a system that's in production for over $1 billion of premium. It works, right? And they can use it and they can implement it more quickly working with us than building it themselves.
We've mentioned about brokers and that user experience, or we'd probably say, this is sort of techie, we'd say UX, wouldn't we? User experience. How important is it to be incredibly quick and easy? Is that almost as important as anything else?
I think it is. And it maybe takes me back to COVID when we launched. And the differentiator at the time was we're digital and we're offering immediate capacity. So complete a submission form, you get a response, it's committed capacity. There's no negotiating, there's no differential terms. It's the lead terms, off you go. Part of that was about the commitment, if you like, and the certainty that you get from Ki, very different from an open market underwriting experience. And then part of it was also about ease of access and efficiency. And I think when we launched in 2020, we really hit the market, obviously, at a time where that was very, very relevant. So brokers were sat at home, they could log into our platform and they could access the capacity at any time of day. So really good timing for us to enter the market. And we had somewhat of a captive audience. Through that phase of the cycle, obviously, we were blessed by supportive conditions, I suppose, a hardening market, reducing capacity. And that meant that brokers came to us for capacity and we were offering something of real value. But I think what we also saw was a mindset, and this isn't really a surprise if you read around the subject. We all use technology on all the rest of our lives. Why don't we want to use technology in placing insurance in Lloyd's? It seems like a small leap to me. But I think at the time, people doubted that brokers in Lloyd's wanted to use technology. And I think that's completely disproved by our model. So we've got loyal users who really like the experience. We've got a chatbot that deals with queries 90% of the time. It's really trying to bring some of those technology elements that we all use in the rest of our life into the process at Lloyd's and making it more efficient.
Obviously, we all know the big brokers, big four, big five, whatever it is, they know that they can make those investments in technology. Obviously, Howden, before they made this decision to use your technology, had obviously spent a lot of money. And obviously, the other big three, big four, have all got that kind of capability. What about the smaller brokers? Is it something that they've been able to embrace, or has it been harder for them?
I think the way we've set up Ki actually works for everyone. So Ki, I mean, it's an online platform. You go to keyinsurance.com and you can log in and you can use our experience. So there's not really a difference in the user experience for us between a bigger broker and a smaller broker.
So as long as they've got PPL or whatever, which of course they have to have got by now, they will find you there somewhere.
Yeah, I mean, we work with all of the placement platforms, so you don't have, there's no requirement.
I'm not just PPL because it's still about 80% of everything, isn't it? But are there other platforms out there?
To me, the point is our model is actually based around the identity of a leader or a syndicate on a risk. So our filter is, as long as this syndicate's on the risk, we will offer capacity behind them. So that keeps it really easy for the broker to work with. And then when they come and put the data into the platform, they know they're going to get an answer. They know they're going to get capacity support behind that risk. That's more the value proposition, if you like.
And I suppose you've already done this work with Howden. Is there a conceivable time where Ki could be writing some of those big broker facilities, i.e., kind of cutting out a lot of that work? And also, this is more writing a portfolio. And obviously, that is the way that a lot of the market is going. You're not in that movement. You're writing risks one at a time. But the power of the computing is almost unlimited. So could the algorithm look at a whole portfolio and say, yep, have that?
Yeah, absolutely. I mean, so I think this is a interesting, multifaceted question. So
could it start writing proportional treaty, for example, or writing delegated underwriting authority business?
So the way I would think about it is the technology we're building has the ability to operate an individual risk level. That's the core proposition. That's algorithmic underwriting. So for an individual risk, assess the characteristic, assess the structure, assess the price, and determine a line size. That's what we're doing at the core. There's many different ways to use that at a portfolio level. We already do. And if you imagine the algorithm, it's a live environment. So we have our data set and we have the algorithm. Well, we can and do run our whole portfolio on a daily or weekly basis to look at the business we've written, the business that's coming up to renew, etc. So as a portfolio use today, there is the ability to underwrite at a portfolio level. So that could be a broker facility. It could be a cover holder piece of business. It could be a treaty. Could be a set of multiple individual risks. So it's many, many ways you could use that technology. And I think it's one of the real advantages and the differentiators is that you actually can't do that with a human underwriter. The point of the leader and the point of the human underwriter is to go really into depth on an individual risk. And our model is almost the opposite, to take that portfolio lens.
What about your own outwards reinsurance protections? Again, is the algorithm out there saying, right, we need to buy some FAC on this, or this territory, we need to do something now, or to optimize our own returns? Or is it doing that kind of work now?
If you think about what we do is we offer capacity and then the broker takes up a certain amount of that capacity. So we could look at the difference between offered and bound and consider optimizing. We don't today because the reinsurance retro markets aren't really set up for that. We can't buy capacity on that basis. I do think in the future there could be different trading strategies. So I do sort of longer term, and maybe we'll be sat here in 10 years' time talking about this.
Yeah, when there are more digital players, I suppose, who can plug into you, and the big top 10 reinsurers are all doing similar things, I suppose they could plug in to Ki, and Ki could say, by the way, I think I'll optimize with a little bit of FAC on this one, thank you. And it'll all be done instantly.
Exactly. I think you could have a very interesting market emerge around that. So maybe algo players trading between each other or with reinsurers. There could be really interesting secondary markets evolve here.
Because of course, the cost, if we compare it to stock exchange, I don't know, 30 years ago, it was still sort of £20 to place an order. So you sort of thought twice about it. It would have all been on the telephone. And then these days, you've got to the stage where there's a Robin Hood and there's no commission and it's difficult to work out exactly how they get paid, but they get paid for deal flow and all this kind of stuff. And can you see a time when the insurance market's going to be like that?
Personally, I can. Yeah, I think my time horizon feels long enough to see that. And I think we're at an interesting tipping point where technology is really changing the cost of doing business. And maybe it's the pressure of the changing market conditions we're in today. Everybody's going to have to tighten their belt and think about every dollar they spend. And I think digital is a real opportunity for the market to become more efficient. So that could usher in a new wave of trading as well.
Yes. I can't imagine we're ever going to end up with a situation where we've got day traders providing liquidity to the insurance market. But it could be possible, couldn't it? You could be in at 10 a.m. and all out by 5 o'clock and having a drink, celebrating and spending your profits.
Yeah, well, I think it's possible. Let's see.
And in terms of that cost gain, how is it playing out in terms of the good old general and admin expenses line?
Yeah, so we're happy with progress. So we set Ki up very much as a bit of an efficiency play. So try and create a business where we track the index on the claims. We obviously pay the same commission as everyone else, but we operate more efficiently using the technology. And now we're at scale, we're seeing some of that advantage come through on the cost line, on the expense ratio, if you like. Much like every other technology firm, we're also investing heavily in future technology. So we're carrying some cost of investment in our result today as well.
Presumably this never sort of, I've bought the thing now, I've got this black box. We were joking before that there was a black box under the table and someone jokingly put a post-it on that said that don't kick the black box or don't turn this over because this is where the algorithm lives. But presumably you have to keep this ongoing investment all the time. So it's not as if it can't just amortize this cost and eventually the cost is nothing, right?
That's true, but also we want to keep improving it. So I think if you think about, firstly, the core algorithm, we simplified a lot of things on day one. Well, we want to make it more sophisticated over time. So we're about underwriting. We're an underwriting business. We're not satisfied with what we had in 2020 or 21 or 22 or 23. So we're on this development curve where we're investing in the future of underwriting, the algorithm. We've also built this partner business where we need to invest in customizing that for partners and how we manage partners and so on. And then we've also started integrating with brokers, and we think there's a ton more opportunity there. So we're not a static business. We're trying to invest for the future and live within our means at the same time. So as you see our cost base, we're trending quite positively in terms of the overall operating expenses. But we're also investing for the future, and it's keeping that balance right.
So I suppose, the ramp-up costs have kind of gone, but it's difficult to not budget in ongoing R&D because we've only just started.
And there are new opportunities, and the opportunities have cost first and then premium later is the reality in the case of our business. It's different. If you hire an underwriter and you think they can write 10 million of premium next year, then it's pretty short term, that payback. For us, if we do a integration with a broker, then the cost comes up front and it's CapEx.
Say the last couple of years running a podcast, I couldn't do a podcast without not talking about AI because it suddenly once something's exploded into the public consciousness. Obviously, you would have been way ahead of me and we would have been calling it machine learning or whatever it was before. When I talked to everyone, I asked what's the top use case, and most of these things are fairly low-hanging fruit in terms of productivity gains, knocking out cost. When do you think we might be getting to the point where most of us saying we're not really looking at the loss ratio, most of this expense ratio stuff? When do you think we're going to start really looking at the loss ratio and starting to really, improve the underwriting? Because hopefully this is more in your wheelhouse, isn't it?
Yeah, we were looking at it pretty early, so you're right.
I can imagine, yes.
Yeah, I think for the service, we use the UK's top 3 user, which is quite interesting for a little Lloyd's business like us. But yes, I think cost is obviously something people have gone after first, and we're in production with Gen AI in our operations areas, and also data structuring. So we're currently using it where we have a human in the loop, and it's a safe place to train, I suppose, is the way to think about it. And we found real benefit there. We've been able to structure data more quickly and add more fields more quickly and make our operational processes more efficient quickly. So it's been a really good use case there, and that's made us more efficient. Where we see the opportunity in the underwriting side is essentially expanding the data set the algorithm can look at. And for us, that would be hugely beneficial because we're already operating this digitally, end-to-end, digitally automated process. So the more data we can put in, the more sophisticated our underwriting can be. So we see huge opportunity in reading documents, essentially, pulling that data in and using that to implement our underwriting. We do also have a couple of service use cases that we're talking about. Internal knowledge management is a good one. So we have our own chat GP key, nicely named, and that helps employees to access information internally. I mentioned the chatbot earlier. We could see future sort of broker service use cases, which would be quite exciting as well.
What sort of things there? We'd be saying, well, hey, dear broker, I've noticed that you send me lots of this. We like that. Can you send more, or that kind of thing? Or
probably more short term.
Have you thought about this? Could you be cross-selling or that kind of?
You could be. I think shorter term, I'd say just about making it even easier for the broker to use us. So,
other brokers who did this also bought that in kind of Amazon-like.
I think it's just reducing cost of doing business. So if the broker could either email us or log into a service and send us what information they have, and we could send them options back, it's that kind of, in the short term, how do you service the broker and help them to reduce the amount of time they're spending on placement? That's really the core use, I'd say, short term.
Long-term one, is it an ambition to get to be a lead underwriter? I mean, do you think, could we have algorithmic lead terms at some point in the future? And one, are you trying to do it? And two, how far have you got if you have tried?
No, I mean, we're not trying to do it. So that, just to be clear, I think our follow model is really good combined with the data-led digital model. So we're very, very happy being a follower. And we're actually partnering with leaders, and we follow leaders in the market. So it doesn't really make sense for us to go out and start competing with them. We're happy to be a follower. Obviously, all the leaders have their own digital strategy, and many of those involve algorithms, and many of those involve further automating their processes. So I sort of see this picture where we're developing our technology as a follower, and potentially that has use to a leader. So it might be that components of our technology would be useful to a leader in the future, but we're not about to go out and hire a load of lead underwriters. That's totally not in our strategy. It's more likely, I think, that these technologies will sort of evolve. Leaders will develop them, we'll develop our technology, and over time that'll create underwriting differentiators.
And I suppose, yes, those leaders, they know that you're following them. And are you able to develop a relationship with those leaders? Say, by the way, out of all the PI underwriters that we follow, you're the best one. I don't know, is that allowed? I don't know, probably not. We probably can't talk to them, can you? Or in terms of competition rules and things?
Yeah, you've got to play within the rules, obviously, but I think the market is a market, and people do talk to each other, and people do work together all the time. So it's within the construct that we work within, that's fine. We tend to have a very good relationship with the leaders we follow. We don't have a contractual relationship.
We've got to be happy, haven't they? Ultimately, it's good, if you have a 50 million line, it's nice to know that it can be amplified, to know that actually that makes me more important in the market, it makes me more relevant to that broker, because I know that if I offer these terms, then this algorithm is very likely to follow me, it likes me.
Yeah, and today that may not be a huge differentiator because there's a lot of capacity, but in the market when it really counts, when the brokers really want you and the clients really need you to support the program, it can be a huge differentiator. So I think we've seen positive dynamic with the leaders that we follow emerge, and they like that we're following them. They see it as a kudos, if you like, that they're one of the leaders we've selected to follow. And to your point, it enhances their business model. It makes them more relevant. So,
and obviously, we've talked about the market. I mean, the market's obviously more competitive than it was when you launched. Obviously, your top line is, not stop growing. Is that sort of, what are the projections when you ask the algo? What do you think we're going to end up writing by the end of the year?
Yeah, I think we'll still grow this year. It's tough out there. Everyone's finding it competitive. I think the conditions are still positive. Price is still good. So we're not pulling back, if you like. We're just seeing a more competitive market. That's going to reduce the growth rate over time.
All things being equal, if you sort of have your dial set to 7.5 or whatever it is, you haven't had to dial it down yet.
No, exactly.
And you're not seeing that the algorithm is declining more often.
No, not declining. I think the algorithm, one of the things the algorithm does is it does the same thing every time it sees the same data. It's unbiased, if you like. That's the word we use to describe it. And
it's quite good because it won't have that recency bias. And I remember as a broker wandering in with a Spanish account, and it had a loss in about 1980. And it was a total loss. And it's just one of the things, that word, it's almost like, don't you show me that word, that account with that name, because I remember that total loss. And it's like, well, I didn't even know. It's not even in the 10-year loss record, But at the end, so it would be nice to be able to just show a risk to the algorithm, and it won't be full of that prejudice.
Yeah, and I think the current market's an interesting one where capacity is growing, and we're seeing a lot of risk being restructured, layers being restructured, stretching layers. And how the algorithm behaves is a bit different to how a human behaves in that situation, actually. It's much more constrained and cautious in a way in terms of the appetite that we offer. So if a layer doubles in size from one year to the next, rate online normally would shrink quite dramatically. Often an underwriter would be writing much bigger limit to generate the same premium to hit their plan. That would be a kind of typical how the market sort of operates. Actually, that might not be what the algorithm does. The algorithm would be much more considered and would say, well, the rate online's gone down and my limit last year was X, and I only want to offer X plus 20% on this much larger stretch. So there are nuances like that where the algorithm operates within this very controlled system.
I suppose the algorithm's not looking at its target or that kind of thing, because presumably you're not setting it.
It doesn't get a bonus, no. So it's not motivated by that.
Yes, the first thing I learned in broking when I came back after being declined for some fairly inadequate risk that I'd been marketing. When you're a junior broker, you sort of get given the sort of rubbish to walk around the market as just an excuse to sort of train you up in some way. And I was very depressed, and sort of, everyone declined this thing. I spent all day, and it had been exhausting, and everyone declined it. But my boss said, "But Mark, underwriters, don't forget, underwriters do have to underwrite."
Yes.
If they don't underwrite, they're not underwriters.
Absolutely.
They won't have any income. So
exactly
eventually someone might say yes, so keep going.
Yeah, keep going. Go tomorrow again.
What about, in terms of the dynamics of the marketplace, has it changed the behaviour of brokers in any way? It's difficult to measure.
The conditions we're in today?
But just in terms of having an algorithmic underwriter out there, has it changed the behaviour of the broker? I mean, I suppose the best broker, I would always assume that they're going to be trying to reverse engineer whatever it is that you're doing, or be able to sort of, know exactly what key would do before they send it.
I mean, it's pretty easy to use.
They probably don't know, right?
Well, they don't really need to, because they can find out in about 5 minutes. It's quite easy to use. So I don't think we see that sort of behaviour. What I would say is I think it's definitely changed how the markets work, because the points you raised earlier, we were the first one to operate digitally, properly, at scale. And we've built this portfolio approach to underwriting. And I think if you look back 5 years, there weren't many people thinking about those two things 5 years ago on a commercial level. And then you look at the market today and everyone's talking about it. And I'm not going to claim that we've inspired everyone to talk about it.
They've been part of it.
But those two themes are absolutely the two big themes of the day today, and somewhat brought on by the shift in supply and demand, right? And what's happening today is we've got plentiful supply of capital because we've had a couple of good years and people have made plenty of money. And that's now starting to shift the supply-demand dynamic. And well, that's shifting pricing momentum, and that's shifting potential revenue growth for everyone and margin pressure coming into the market. So those sort of dynamics have happened. Keys had really nothing to do with those dynamics. But I think what we have done is create an example, if you like, in the market of how things could be done differently, which maybe has led to some other people taking action.
At the moment, yes, say you're a big broker and you've got your big facility that's your own fast follow facility, and then you've got the relationship you've got with Key and others. You're probably looking at, 20 or 30% of everything sort of pre-done, pre-placed or ready-mixed. Where do you think that will end? It's difficult to know, I suppose, but I suppose at some point, I don't know, most people say it won't go over 50.
As fast
in terms of how much is follow and how much is more a sort of manual lead.
I think everyone knows we need a sustainable lead market, and that's what all these fast follow vehicles are built around. So we can't go so far that
and I suppose a sustainable lead market means sustainable alternative leads.
Yes.
If you're the broker, you've got to think far enough ahead. Everyone can remember the moment, when that fantastic lead underwriter suddenly wasn't there anymore. Head-scratching moment is like, what the hell are we going to do now? At the next renewal, we've got a whole portfolio of this that we need to renew. We need to find somebody else pretty sharpish. And if they hadn't necessarily had a chance to train themselves and cut their teeth, then I suppose you need the lead, you need an alternative lead, and ideally you want another alternative lead who's there in the market, who's happy.
Yeah, you need challenges and you need competitive tension. Otherwise, you're kind of in a difficult spot. I think the thing that's interesting is, how does the market evolve in this period of expense pressure? And I'm going to call it that because we can see that in the numbers from various different players. And so really, I think the objective on both sides of the table here should be to make ourselves more efficient through this period of pressure. If we're going to do that, then we need to find ways of using the technology to be able to do more with less, essentially. And the other thing I'd say is we need to try and make it sustainable change. So if we create some horrendous soft market by all this capacity chasing the same business, that's not really good for anyone, because we're into a wildly gyrating rate environment, which is not good for us. It's not good for the clients. It's not good for the brokers. It's a pretty difficult environment to work within. So I think I would focus on efficiency and sustainability as the approach to follow. So we don't want follow to take over the lead. That's not going to work. We don't want follow to squeeze out the lead. That's not going to work. But within the part of the placement that is follow, how do we do that as efficiently and sustainably as possible? And I think the brokers are being quite thoughtful about this, and each of them have got a different approach. You asked about different size brokers. I think they've all got their own strategies. Some of them have already built their own technology in-house. Some of them are outsourcing it. Some of them are renting it. It's very, very unique to an individual broking firm. And I think the most successful ones will build something that's sustainable through a cycle, because it is now available. You can now create a broker facility of a decent scale. You can connect into open market follow, and you can make your broking teams far more efficient by using that on a,
you can do
on
a
a
lot
systematic
more
basis.
with the same number of people. Yeah,
do more business. You can potentially write bigger layers and outcompete local markets. You can bring new capacity to the table and grow the market. There are lots of things you can do with that model that you couldn't do 5 or 10 years ago. So I think if you think about it strategically and sustainably, then actually there's a real opportunity here for Lloyd's and London to stand out from the crowd. I would say you don't see this necessarily anywhere else on your travels.
What about outside Lloyd's? Some of these big broker facilities are starting to see reports of them being deployed outside the London market. It's been a London market phenomenon up to date. Do you think that the whole market, the global wholesale specialty insurance, reinsurance market that we operate in, do you think it's likely to go that way at some point?
Yeah, I mean, as you say, there's examples.
We'll stop talking about it being London market. It might be just some of this London market technology might be sort of exported everywhere and everyone plugs in.
The beauty of Lloyd's is the licensing and the rating and the syndication, frankly. Those attributes make Lloyd's stand out, I think. So where we've seen the facilities go beyond London, beyond Lloyd's.
Yeah, because Lloyd's is already everywhere anyway, effectively, if you've got 180 licenses or whatever it is. So
yeah, so I think that's a differentiator for Lloyd's. And I do think, our model is built in Lloyd's and it's for Lloyd's, and we're trying to grow Lloyd's and make Lloyd's the best market it can be. And our technology, we think, enhances that, and the capacity we bring, we think, enhances that. So hopefully what it will do is it will make Lloyd's stand out in the market wherever we are.
Talk about those licenses. They're all regulated. There's 180 different regulators around the world who've all said, yes, Lloyd's is good. And obviously you've got the sort of unofficial regulators of the market being the credit rating agencies, giving Lloyd's very nice insurer financial strength ratings. What if a regulator came to you and said, look, Mark, can you kind of show your homework? Can you show me what you've been doing? All the stuff that they like, treating your customers fairly and proving that you're solvent at any given moment. Can you explain every underwriting decision that the algorithm has done?
So I guess a couple of questions in there.
You can sort of press a button to say, dear regulator, here you are. In fact, I'll send you a live feed of everything I do if you want.
Yeah, we can certainly do that if anybody wants to come and look. I think I'll come back to the fact that what the algorithm's actually doing is it's a very well-controlled process that runs the same every time. And we've actually decided to have basically a static version control. So we have governance around every single update we make to the algorithm. So we always know what's happening in the algorithm at any point in time. So if anything, we can show greater evidence over what is happening, because we know that we've got the same data and we know that it's gone through the same process and we know that it's going to produce the same answer every time. And that might not be the same answer a human would come up with, but it is the same answer out of the system every time. So I think, yes, I'd say we can explain that very, very well. In our model, we tend to offer smaller capacity on a more spread basis, and it's a different model. So I think regulators understand our model.
The algo doesn't suddenly wake up and think, I'm going to bet the farm on, put it all on red or anything.
No, that's not the way it works. I think you've got to remember as well, we're born out of Brit, if you like. I was the CFO and the CRO before that. We want to have an insurance company. We're running an underwriting company here. We want to have the right controls. This isn't kind of a tech startup trying to do insurance. It's an insurance company as part of Fairfax, which is one of the world's largest insurance groups. It's a pretty mature model. So we do things carefully and thoughtfully.
Now that you're maturing and you can look anytime you want on your sort of dashboard of different things that you've been getting up to as a boss, it must be great having really good management information, because obviously most managers will complain that they don't really have very good management information and it takes them a while to work out what everybody did yesterday. With you, it's completely instant because it's all digital, so you can drill down into anything that is in the book right now. When you're analysing that, are there any classes or anywhere where you think it gives you a big edge? And conversely, are there anywhere it doesn't give you an edge, or where you think, actually, this doesn't work as well as I thought it would? Is it classes, or is it geographies, or is it just, I don't know. Anyway, I'm just asking you now that, because you're able to survey your book all the time, and presumably when you have an idle moment, look at the screen and see what's going on.
Yeah, so I think the way I think about that question is there's more to trade, to get the scale with the brokers that we want to trade with. we're writing a spread of classes of business. So I think the pitch to a broker is more compelling if we're doing 30 classes of business than if we're doing one. For every class of business, for every market they interact with, they have to use a different technology and a different process and a different way of working. That isn't really more efficient for a broker. It's kind of hard work for the broker because they've got to go and repeat the process for many, many different people. So I think the model and the way we started Ki with that spread of business, obviously trained on Brit data. So we were starting from a place where Brit had scale, if you like, but that gives us a good
because Brit was already
writing
writing pretty much everything that you can write in the London market.
There are some things we don't. We don't do aviation, we don't do motor and things like that. But in the core Lloyd's classes, we're trained and we have models. So I think that's a good part of the value proposition to the broker overall. You can't just think about it as one broker. You've got to think about the broking house as a totality. I think when you go to your question and where's value the highest, well, I think value is the highest where policy count's the highest. I mean, that's why technology is taken over in personal lines, if you like, because on millions of policies, it's extremely valuable to have that saving of a few seconds every time. In our market, we've got much, much smaller numbers, but we still have classes like the property market where there are much, much higher policy counts. And the technology is very relevant because...
Of course, where there's submission flow, sometimes there's a big bulge of submission flow, which is what the London market's here for. And presumably in the last few years, obviously, we've had much more submission in the classic property sort of classes as property fact, DNF.
And there's good levels of data and it's, can be geolocated and we push it through this sort of structured model every time. And so the data depth and richness is pretty good there in the property market. So that's an area where it's really relevant. As I see other areas, and we talked a bit about binders and treaty earlier, the technology can be advantageous there. It just takes longer to get to the point, I think, where the market is ready for that and our technology is ready for that. So we have some areas like that where we're more in a training mode, more in a hybrid mode. We're in the market and we're using algorithms, but they're not fully fledged in the way they are in the higher volume classes today.
So we'll be seeing... At some point, there might be an announcement or something about, so we're in the treaty market, we're in a delegated authority market.
I know we do that today.
You already
do that today. The shift in the market takes longer, I think. That immediate gain of speed and efficiency isn't there. But if you're only placing 100 programs as a broker, it's not that huge saving going from a week's worth of work to 5 minutes of work. It's not really a major benefit to the broker in the same way.
Would you say that what you've done with Ki has been accretive to the marketplace? It's a key thing. If you want to start a new syndicate at Lloyd's, you usually want to come with a good story to say, by the way, I'm not going to cannibalize what everyone else is doing.
Yeah, absolutely. I think we actually have some great conversations about this with brokers. I think brokers love to have something new to talk about. When they're out on their travels and they're looking to bring business into London, what are they going to talk about? Well, Ki's a great thing for them to talk about because it's new, it's different. Often a client has heard about it. We've had many, many instances where clients have actually asked for Ki to be used on the quote. Maybe they bind us, maybe they don't, but they've heard of the story of Ki. They're interested in technology. They want to be part of that experience and part of what's happening here in London. So yeah, I definitely think we've been accretive to London.
If you're bringing more capacity quicker, then that's got to be a good thing, hasn't it?
Yeah, and most of the time we're talking about huge global programs. They want capacity and they want new solutions. They want to see the market evolve. They're part of our market as much as we are. The risk managers and the management in these businesses are excited about the potential for this model.
Often in technology sort of plays, in the other segments, we all know the technology story of the last 30 years, first mover advantage is a really big deal. Do you feel you have got a big advantage?
It's an interesting one because the market hasn't digitized. So we're a digital player in an analog market to a degree. I think we've got a head start and we're doing okay in our business model. We're doing well in our business model. We've now built over 5 years a lot of knowledge. We've hired into the industry people that didn't exist in the industry before. And frankly, we've upskilled them to understand our business and our business model. So I think those are all things that are hard to replicate. So as or if the market shifts over the next few years, then there'll definitely be advantages to us. I suppose the thing that we're trying to do is, as far as possible, find those partnership opportunities. So the capacity partnerships, we've put a lot of CapEx into building our processes and systems and knowledge base. And we're able to use that to work with partners to get them into the game quicker, if that makes sense.
Yes.
So We're not trying to sort of keep it to ourselves and not let anybody in. Same thing on the broker side. If we can reuse the technology, then let's reuse the technology. And if someone comes along with a better version of it in the future, then fine. As long as we haven't bet the farm on it, then it's not a problem. So it's this mindset of, do you want to build it yourself or do you want to partner on it? Well, we're here to partner if people want to.
Yes, it's a bit like, I don't know, sort of back in the dark ages, you used to use a piece of paper and a sort of lined, ruled paper, mathematical, square line paper. And then, someone came up, Lotus Notes or whatever it was, the first one that come up with a spreadsheet. And you think, well, we all need that. And then now Microsoft has sort of superseded that with Excel and 1,000 different versions of it. You think, right, okay, no one really uses Lotus Notes anymore because they moved on, it got superseded. And at some point, we'll not say, are you the Lotus Notes of algorithmic underwriting?
Hope not.
You don't want to be that one, do you? You don't want to be word perfect.
No, but I think, competition is a good thing. And we're seeing it in AI. We've seen the major houses in the US get a head start, and then maybe restrictions on use elsewhere have created innovation and new technologies elsewhere, right? So,
actually, what about innovation? Obviously, we've got this innovation class. Presumably it's something you can't really go into. You can use 5% of your capacity for innovative things. Presumably the algo is going to say, actually, no. Was that right or was that not right?
So we actually haven't entered any new classes in our history.
Yeah. Is it almost the definition that you have to wait until they're more mature so there's more structured data around them?
It's a question of data, essentially, at the end of the day. So if we found a source of data or a partner that we could train an algorithm with, then we could enter a class of business, but we don't have that today. So we're constrained by the data today.
Yeah. An interesting thing about innovation, the classic thing is you go to an underwriter, ask them, and they say, well, where's the 10-year loss record or whatever? I want to know, I want to see how this thing's performed before I can sort of commit to insuring it. Some of the good things about AI is that obviously you could come with a virtual loss experience that's being computed and sort of, not say imagined, but based around smaller amounts of data projected further into the future with a greater degree of accuracy. Do you think we might be able to go that way at some point in the future? Because a lot of these really innovative things, they're a problem, aren't they? They're very difficult. One, there's no loss record. They're untried and untested. And of course, they always want a 20-year period, almost from day one, which is quite hard.
Yeah, and I think we've seen some good examples of innovation, and like the cyber class has been a great example, right? Where the market's been at the forefront, developed a product, carefully underwritten it in the early years, and then it's grown and scaled. And I think that's the approach you need to take.
Yeah.
I think for us, if there's no data, we can't train an algorithm. So we need to be careful. We'd probably be looking to partner closely with a leader that had expertise to gather that experience over time.
So you can be learning together. And so we're not actually writing this at the moment. We're going to
start small, always start small. Our line size is smaller, as I've said. So always start carefully and then grow it from there. But I would say as a principle of innovation, I think doing something is important. It's got to be commercially viable. So start small, but do something would be the way to innovate. And as we get bigger...
To have it in a sort of sandpit and say, right, let's look at these ICX class businesses. And obviously, then very quickly, in only a few years, obviously, suddenly you've had 5 years experience after trying something new. What about something like parametric? Again, that's very new. Is that something an algo can look at? Because each thing's bespoke again. But there's an index, so presumably you can kick the tires on the index and say, do I believe this index to be a reasonably accurate thing?
Well, I mean, you could model it. To me, this is about prioritization and focus. As a business leader, you got to decide what you invest in. You got to decide what you focus on. And do we want to focus on new and shiny things or building the core business out, working with the partners and integrating with brokers? To me, 99% of the opportunity is in the existing flow. That opportunity for efficiency far outweighs the potential today of distracting the team with the sort of smaller innovation type projects. As we get bigger and as we get more mature, then I think there'll be a shift between the upside in core and the opportunity in new, if you like.
And you've got tons to be getting on with it.
Exactly.
You mentioned before about being this digital player in this analog market. Presumably there's going to be big benefits to when the market does properly digitize. Do you think we'll see the market really kick on? And it's something you're sort of, presumably you're dying for this to happen.
Yeah, I mean, the whole thesis of Ki. So you wouldn't be surprised to hear me say, I think it would be a good thing if the market had more use of technology. I think there's a lot happening, and I don't know if it's the first thing people always talk about. Some people like to talk about it a lot, but a lot of people are doing it quietly in the background. So there are subtle changes happening. There are people investing. The brokers, I think, see the real benefit from the use of technology in their businesses. And also, I think, see the opportunity to make that more systematic in their process. So for the broking house, it's not about the individual trade, it's about scaling that across every trade they place in the market. That's where they get the real value from. So I think there's more happening than maybe meets the eye. And I think we will see next 5 years, say, a significant shift.
Now this business is maturing. What do you think the biggest learnings have been so far? What have you learned?
I think the broker mindset to technology, we had a hypothesis that they would use technology. There were a lot of doubters. I think the broker mindset is definitely favorable to technology. And, we've benefited from that, but I think that's got a lot more upside in the future. On the underwriting side, we had some helpful incoming knowledge on this. Running your processes properly and being disciplined is super important. And I wouldn't put those to aside to innovate, and we haven't. So we've been through the same cat losses everyone else has been through. We've been through the same cyber losses. We've been through the same cargo issues and hull issues. So we're living the same ongoing pressures as everyone else. The market is complex, and not underestimating the complexity is a big lesson. Every segment in every class in every division that we write is complex. And that's when I talk about institutional knowledge and I talk about the way you need to manage a digital business. We've got all this depth in that underwriting approach combined with all the brokers wanting to do it differently and doing it their own way. That's really the learning that we've got over the last 5 years, is how do you approach each of those markets? Exactly where do you need to customize the model, be it the front end model or the algorithm, and then managing that on an ongoing basis. So there's this huge depth of trading in the market, which is, there's not one sort of silver bullet learning that I can tell all the listeners, but I think it's probably that respect for the complexity of the market. It's really a big thing that we've sort of brought in at Ki, and we're continuing to respect.
Every broker will tell you it's always more complicated than you think, and sometimes you slightly poo-poo it, but actually it's a fair point, isn't it?
Absolutely, yeah. I mean, we're here for a reason, right? The market is here because it's writing risks that can't be placed elsewhere, and they're more complex, they're bigger, they need different structures or different conditions than a standard underwriter would put on them. So it's here for a reason. It's a beautiful thing in totality, but I think it can evolve and be even better in the future. And that's kind of what we want to be part of and help the market achieve.
One thing, as the ultimate responsible employee for Ki, do you feel that responsibility? Do you feel a greater responsibility than a CEO would anywhere else? Because it's sort of who is in charge of turning the dials up or down. It's you now, isn't it? It's not necessarily anybody else.
In terms of Ki's dials?
Yeah, well, in terms of, its appetite, say, well, I'm going to feel a bit more risk on today, or I will accept a slightly lower return hurdle because the market's changed.
I think that's the same as any CEO, I'd say. Any CEO in the market's making those decisions.
But yours is more direct feedback, isn't it? Because it could be your hand on that dial.
I think a lot of CEOs would like that, to be honest, in the market. So
I think we'd have even harder and softer cycles, and they go even harder and faster, because certainly many of the CEOs that I've probably had on the show have been more aggressive than some of their underwriters.
Yeah, and I think if you've seen our profile, what happens is when market conditions harden, we grow very rapidly. And then other people become more competitive, and we tend to see the top come off our numbers.
Yes, we've seen it tailing off. So that's a good thing. Because I always thought, yes, it's wonderful that you can go from 0 to 60 really fast, but you could go at 60 back to 0 just as quickly. Well, this has all been fascinating. I'm really, really looking forward to the next time we talk. We've got to give it a bit of time, but things are changing so fast. Thanks very much for giving me the time. I've really enjoyed talking to you. I'm sure there's new things are going to be developing all the time, and new questions that will be bubbling up in my head. I was saying before, normally I have about 10 questions that I ask everybody, and with you, I think I had about 25. I had more pages of questions than I normally do, because I think everything's so interesting. The more you think about it, the more questions it raises. So thanks so much for coming on the show.
It's been an absolute pleasure. Thanks, Mark.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance podcast is produced in association with Advantage Go, enabling enterprise-scale underwriting through a single pane of glass. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.